The crashing Chinese stock market and the government's surprise moves to stop the bleeding are calling attention to a single unfortunate fact. No major advanced economy statistics are viewed as skeptically as China's. Why is it so hard to get a clear economic picture? Murky politics, unreliable data, and opaque decision-making. China, for instance, did nothing to broadcast its recent currency devaluation in advance. Some believe it shows China's economic leaders are more worried about the economic situation in their country than they've let on publicly. Another example, economists widely doubt that China grew at a robust 7% pace in the second quarter, as the country claims. It may be as low as 3 to 4%, according to other indicators, such as power generation and passenger travel stats. Central banks in most countries publish detailed meetings minutes, forecasts, and numerical goals. But China is much more stingy about what it releases. So how do people get accurate measures of the economy? They use proxy indicators. One approach is called the Li Keqiang Index. It looks at 3 proxies for economic activity: loans, electricity consumption, and rail freight. Several analysts and research firms have since come up with indexes based on these stats, adding in things like property development, passenger travel, and sea shipments. China's more transparent than it used to be, and some experts say suspicions about China's statistics are overblown. China also now relies more on its own surveys when calculating GDP than on local government statistics, which tend to be skewed positively. But the country's overall lack of transparency is adding to mounting concerns and may not have the ability to guard against economic shocks. That's the short answer.